Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders. Welcome to the How to Make Money Trading Stocks webinar that we do every Friday. Thanks for joining us a little bit early today. The market is a short day market, and we're seeing what's going on. A lot of times some of the early results from Black Friday are in before the market closes, but the market right now is holding up okay. Given the huge rally that's gone on over the last few weeks since the day after the election. I want to welcome Mike Traeger, who's with us with Dallas, Texas. Good morning, Mike.
Good morning. I am awake.
You are awake. Okay. Well, I'm enjoying that it's not daylight savings time anymore, because I only have to get up now at, like if I want to be up a half hour before the market opens here in Hawaii, I'm up at 4 o'clock. This morning I got up a little bit earlier just to see how the futures were doing, and so I was up at 3:30 this morning. But hey, I've got a coffee maker that has a timer on it, so it's already cooking by the time I get up, so I'm loving that. And so, Mike, did you have a good Thanksgiving?
Yeah, thanks for asking. Had a very small, quiet dinner with some friends here. It was, terrific.
Yeah. Yeah, so, well, I got my fill of, as I shared with you earlier, I'm a little bit stiff and sore this morning because my wife has me painting bedrooms, getting ready for our family to get here for Christmas. And so I was painting the ceiling in 2 bedrooms yesterday, priming them, and then actually putting the coat of paint on them. And so we're staying very busy. The house, we moved back into our original house here in Hawaii that we bought back in '94 when we moved back, and we had rented it out for 12 years, and it actually held up pretty well, but it's got a significant amount of self-help projects that are keeping me and Michelle busy. So I want to remind everybody that all the materials we present are for training purposes only. Traders should always paper trade any new method part of the risk of their own personal capital. Michael Bishop is not with us today. So one of the big things that I really hit on with active trend trading, and it is available to all premium members of the active trend trading system, is we train every Wednesday evening, depending on where you are in the time zones across the U.S. This past week I gave a demonstration of how to utilize the IBD 50. Yeah, as most of you know, I am not a can slam guy. I don't buy breakouts, and I don't do that kind of stuff. However, I like IBD for their fundamental analysis of their stocks in their IBD 50 list that they put out every week, and so I really enjoy. I utilize that, and we gave a demonstration of how to just work through the IBD 50 on a weekly basis to identify the strongest of the strong growth stocks that are identified on that list. I hope everybody enjoyed that particular presentation. This week we're going to be talking about, as you know, we've adapted our strategy 1 of the active trend trading system to incorporate trading leveraged ETFs. Now, a lot of these leveraged ETFs, they both the directional that go with the market, and then also the inverse, they tend to reverse fairly quickly. And we're going to be talking about, don't buy the bottoms unless. We're going to be covering that on this coming Wednesday, the 30th of November. So that'll be available for all premium members. And then recordings are included later on. And so, Mike, we're going to be talking about something very near and dear to your heart on Wednesday night, which is basically how to utilize and how to look for divergencies and extensions away from the moving averages, where you can get some reversion to the means and that kind of stuff. But we're trying to get away from just buying the bottom, and the inverse of that, selling the tops. So I think it'll be a pretty good session.
Sounds good.
So let's see here. Okay, let's see what's going on. Trump rally continues, but it needs a breather. S&P has gone straight up rally since the day after the election. New all-time highs. No reversal candles are in place yet. At the same time, the NASDAQ appears to be the lagger of the three indexes that we track. Appears to be the lagger, has not pushed to a new high. And so the question is will this be the drag on the other two indexes, or will it eventually catch up and start moving directionally with the other two indexes? The Russell has just, Mike, the move on the Russell over the last 2 weeks, has that been a surprise to you?
I think it's been a surprise to everybody.
Yeah.
You know, the other night on the webcast, I think I used the word freakish.
Yeah.
And I would still use that word. I mean, assuming that, you know, has the market closed now?
No. Oh, today?
Well, for today, yeah. Is it done now as of right now?
It shouldn't be. It's supposed to close at 1 o'clock Eastern time.
Oh, 1 o'clock Eastern. Okay, all right. Well, assuming that the market closes about where it is right now, I mean, the Russell is up again today. It's only up a point, but, you know, it's up. And that will be the 15th day in a row that the Russell has closed higher than it closed the previous day. Yeah, that's 3 weeks without a down day. And that's why I use the word freakish, because, you know, that just isn't normal.
It's probably breaking a record, because I heard that a couple of days ago that it had gone up, you know, like it was 11 days or 12 days at the time, and that hadn't happened since 1991, something like that. I mean,
yeah, well, wouldn't surprise me, and I don't know that. I haven't, you know, read up on it, but it wouldn't surprise me at all that this is some kind of a record for a period of, you know, several decades.
Yep. And so, but I have been noticing that a little bit of the momentum on the oscillators is starting to slow down a little bit, and we'll look for that price action to start slowing also. All, you know, the top two, the S&P and the Russell, a nice little pullback into the moving averages, if this uptrend is going to continue as it is what's needed, so we could, you know, be looking at some index type trades. Outside influences coming up. Hey, December 14th, the Fed meeting. The other very strong, at least the betting odds right now, is that they're going to go to a higher interest rates. And then other outside influences, basically what's changed? What has changed since the election? And, you know, basically, as we've talked several times, Mike, nothing really has changed. And I added something a little bit new to today. The only thing that's changed is outlook. And i.e., that's the opinion that with less regulations, more of a pro-growth type policies, that will stoke the fires underneath the U.S. economy. What's your thoughts on that?
Well, the same as we talked about the other night. I mean, this rally the past 2-3 weeks is based on nothing but pure emotion. I mean, nothing really has changed in terms of economic fundamentals.
Right.
You know, global economy outlook, equity valuations. I mean, nothing's well, if anything, you know, equity valuations have only gotten more extreme to the upside.
Right.
I mean, nothing's really changed fundamentally. There are a lot of hopes and expectations, or as you say here on the slide, opinions about what some of the policy changes that Trump's, you know, new administration might propose and enact, and the effects of that. And people are running with that. It remains to be seen if any of that is really going to happen. and if it is going to happen, what the effects of it all will be. But those are very macro, long-term considerations,
Right.
and we're not going to know for a year, year and a half, 2 years about that kind of thing. So this whole rally, the last 2-3 weeks has been anticipation of that. And the stock market does tend to get carried away and go to extremes and become irrational at times, either to the upside or the downside. And I think that the last couple of weeks has been a really good example of that.
Yeah, I mean, basically, this year has been kind of interesting and unique, I think, as one. We've had several, and I know we're going to be talking about this a little bit later today as we work on the early warning alert system for next year. But we've had several straight off the bottom rallies this year in the indexes that have basically been some very significant moves, but almost very challenging to trade because they have been just straight off the bottom with no no good signal that there was going to be that type of a rally. I mean, I think that's been unique this year.
Yeah, and emphasis on the word straight, because if you look at the charts on a couple of these rallies, just looking at the indexes, coming out of these bottoms, some of these rallies have been, nearly vertical.
Yeah, yeah, and
I mean, nearly a 90-degree angle on a chart where things just went straight up out of nowhere, and there's no way to be able to anticipate that, nor is that exceptionally healthy price action.
Right.
We've also seen after these rallies have happened, and you get this straight up price action, which can go on for 2 or 3 or 4 weeks. There's some type of retracement or give back.
Right.
Until the next, little incident.
And so, well, I'm kind of interested just to see, where's the rocket fuel going to actually kind of expend itself. I remember when I was flying with the Navy, you'd have a service ceiling on your aircraft where basically it just couldn't push any higher. Your aircraft, you take it into a steep climb, and at some point the momentum would wear off of that aircraft, and there was no place to go except back down. However, we haven't hit that point yet. Here's where we were with the percentage of stock above the 20-day moving average as of last week. We had moved up to the 74 level. Today, actually, first thing this morning, 7 a.m. Pacific time, we had jumped above the 80% line. And Mike and I don't pay a lot of attention to this particular indicator here in this between 80 and 30 level, but we have pushed up into the 80, as we can see, and this combines this with, here's the SPY, which emulates the S&P, and it too gapped open this morning. Now what's going to be very interesting is what will happen on Monday, but right now we're not seeing any per se weakness. However, we did get a gap open this morning, and if there is any hint, any kind of issues over the weekend, and we get a gap down next week, that may be the first clue that we're going to get some kind of a pull back into a level, a good level of support for a potential bounce. Now we have, like I said, the first strong level of support is that the past highs where it broke out of. But right now, we don't use this to trade to the downside. Other than, we basically utilize this when it gets overextended up in this area. We know it doesn't spend a lot of time up there. As we can see earlier in the year, back in March, it pushed up high almost to 90, then fell back down. Started a nice little. This resulted in a nice little pullback in the S&P. Same thing in June, bumps up above the 80. And resulted in a very nice correction in the June time frame. Got up here and as you can see, sometimes, and this is a very good example of sometimes this indicator, we get up above the 80 again in July, it pulls back fairly dramatically. However, price action didn't pull back that much in the S&P. And then the rest of the year was kind of like a rollover, and then bam, off to the races here. Off of these lows. And this is part of the thing you can see here. Well, we'll look at the S&P chart here shortly. But right now, Mike, other than to say, okay, this rally should be coming to a place of rest. I'm not saying it's going to necessarily correct real strong, but with the level that it's extended, we need a good pullback before we be entertaining any type of index trade to the upside.
Yeah, I absolutely agree, and I think the best use of this indicator, this metric, is to look for, short to intermediate term, very oversold conditions when we get down to around, the 20, 25% area. And when it gets up to this area around 80%, I don't see using this as you've indicated, I don't see using this as an indication to short anything.
Exactly.
But as you've mentioned, it does seem these moves, these rallies off of these oversold conditions start to run out of energy. And when this indicator gets up around the 80-ish area, and to me, and I've never, until this morning and looking at it while you were speaking, if you're wondering, with these early warning alert signals, and you get into a trade and you've had the good fortune to stick with it for a while, a valid question to ask is, when do we get out? When do we take our profit?
Right.
Well, when it gets up to around 80. Because that doesn't mean that the market's going down, but the big push, the big energy behind the rally seems to be fairly spent.
Right.
By the time it gets up there, and probably a good place if you're in a trade to consider taking profits. Not to say the market can't still keep going up. It can, but it appears that it's going to want to rest or consolidate for a while before it does. And if you're in a position and you're just kind of going sideways for a while, which this indicator does seem to indicate, then sideways isn't helping you a whole lot.
Yeah, basically the move is kind of gassing out. I mean, it basically is, and as you said, not necessarily going to go down, but the upward momentum is muted to some extent, and that's where we want to be looking at taking profits anyway, because as it mutes and moves sideways, in a sideways move, unless you are playing these just really short-term moves, there's not a lot. There's not a lot of profits to be made in that, and so you can just sit there and go, okay, wait, we're going to wait until we get our next signal, and that's one of the things that we try to implement with active trend trading, is just to wait for the proper signal and then get in, take the ride, and then hop out. Here's where we're sitting with the indexes first thing this morning, as we can see. Here is what I was talking about. Look at this. I mean, the Russell was the lagger all year long, but all of a sudden now look at it. It's, for the year up 18%. Pretty remarkable. Everything is above last year's high, pushing it into new territory. Once it pushes into new territory, then you've got to utilize other tools to kind of figure out where will a level of resistance be, and that's where the Fibonacci's come in, utilizing the Fibonacci's off past moves to kind of determine, this is where we, could identify a level of resistance that isn't due to, per se, an overhead level of resistance from past price action. So let's take a look at let me keep an eye on my time here so we can, because I'll be jumping out of this into the next. Here we go. And here is the S&P. As you can see, we broke up. I want to just highlight a couple of things here. we have jumped above this level. This is the past high, the 2193 level, and we're not that far above that. So that's a level of pullback support for a potential trade. But as we can see, we've gone up on this 1, 2, 3, 4, and that wasn't an up day. 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So I've gone up about what? 10 of the last 14 days. What's happened on the true strength indicator? One, it is up in an area with the index, the S&P index. It tends not to get much above the 50 level before it starts working its way to either a sideways or a pullback type move. We've got a fairly significant extension away from here's the 8, here's the 20, here's the 50. This has been a strong move back above the 50. This is a bounce from the 200, dramatic move up. As we are pushing to the new highs on the weekly chart, we have to ask ourselves, is the true strength index and the momentum also pushing in new highs? And the answer to that question is no. But at this point, there's been no price action. While this is providing us some negative divergence on these indexes, let's draw a line across there and a line across here. And while those are not, while we're getting some negative divergence, price action is not confirming that the uptrend is slowing at any whatsoever. There we go. Get rid of those.
And yeah, I would say these are potential divergences that are setting up, but the final setup is not there yet. And certainly there's no no price action to indicate taking any kind of trade to the downside. There's just a potential for a divergence, which at this point may or may not follow through, and we don't know yet. But it's worth keeping an eye on and being aware of.
Yeah, because what we need to have in place, folks, is basically, as we saw one of these last moves up. Let's take this one in February. This is a weekly move. Came up off of this hammer, pushed up, pushed up, pushed up. Really nice run back up to the top of the Keltner channels, and then we had this up week, partly down week, back up week. But as you can see, moving up, all the upper wicks on these candlesticks were very short until we get to this one, and that was the indication that this has finally run out of gas. We get a close below the halfway mark on the candle, and then that led to the nice little pullback, and then a rebound, pullback again, and then a rebound. So at this point, this did, like on this one, we got a little upper wick. However, we didn't close back down, below the halfway mark, and so that discounts that as a potential reversal type of entity. I've been studying, Mike. What I've been studying, I don't know. No, I've been looking at just some different patterns. And I know that you're a big proponent of looking at what that upper wicks, where the upper and lower wicks, as an indication of subtle momentum shifts.
Yeah, recently I've gone back and revisited. I know you and I have both read a little bit of Thomas Bielkowski.
Yeah.
And some of his findings on candlestick signals, where he looked at thousands and thousands of them over a number of entities over long periods of time, and sort of debunked some of the myths that are associated with what we've been taught about candlesticks.
Right.
And the whole trigger to this recent rally, if we go back and look at right around the election day, there was an inverted hammer on, and there you go, you're pointing to it, that inverted hammer, which sort of, triggered, the whole rally happened
Right.
after that. So we always look at inverted hammers as, kind of bullish candlesticks at the bottom of a downtrend.
Right.
And, they very much are when they work. But if you read Bukowski, you'll find out that they don't work much more often than they do, at least statistically. And it's just kind of interesting to, have that perspective.
Yeah. And what he talked about also in his book, a lot of it is that, these large, bodied candles, a lot of times they were more indicative than, because I know he liked bullish and bearish engulfings.
Right.
And that they tended to be more indicative of what was going to transpire. So on the NASDAQ, let's talk about, and this is what I talk about, the basically muted response. Here is here's the day of the election, and here's the response from the NASDAQ the day after the election. As you can see, pushed up higher. But then what was really interesting is that price action gapped up the following day on the 10th, which would have been Thursday, and then fell and basically put in a bearish engulfing pattern of all the, this price action over here, and then continued to drop back down almost into the support zone that was from this past low, and then you get a little, then you get a nice little rebound back up. However, it is not coming even close to the, past highs of about the 49.12 area, and we're getting a series of these little spinning tops, which with spinning tops, they are spinning tops / dojis. They are, some people consider them a continuation type pattern. Other people, basically say that what the market is showing us, or the index is showing us in this case, is indecision. It doesn't know which way it wants to go. And so I think that's been fairly, fairly clear. We get like I said, we get a nice move up on Monday, but then Tuesday, Wednesday, Friday, not a lot, the NASDAQ's not getting the same traction as the other two indexes. We see that selling is coming in. The upper wick on a daily basis, or a weekly basis, is, you can tell that it's there. So we know that that's a pretty good level of resistance up at about the 48.84 up to 4900. Hold on just a second, please. There we go. And so one of the things with the NASDAQ, Mike, is it's not as extended away from the moving averages. And what's interesting is the momentum on a daily basis has rolled over. True Strength Index has basically hit a level of past resistance. And how would you grade? Well, we're not really negative divergent. It's just that we're pushing up towards the high, but our momentum oscillators are basically kind of flat, if you will.
I have two comments to make, and
okay.
One is about what you just said about, there's no negative divergence on the weekly chart.
Yeah.
And and this is just me, I would tend to disagree with that, because one of the things that I look for, and that I do consider a divergence, is when you get price action in an area that has provided, significant prior resistance or significant prior support, and you see that the oscillators are not doing the same kind of thing. The oscillators are making either higher lows or lower highs as you're in that same area or zone of resistance or support that has been visited before.
Okay.
To me, that is a divergence. And Dennis, you and I have looked at, thousands and thousands of charts over a period of years. And, divergences aren't perfect. They don't always follow through the way you think they should. but a lot of them do. And this is a divergent setup to me. You have lower highs in these oscillators on the weekly chart as prices going back into a previous area of very strong resistance. Remains to be seen if that's going to follow through or not. That's one comment I would make. And the other comment I would make, when you're showing your NASDAQ charts, Dennis, you're using the NASDAQ 100, aren't you?
That's correct. Yep.
Okay. If you were to show the true NASDAQ Composite Index, which is COMP,
I knew that.
It looks different.
Oh, it does, yeah.
Looks different. I mean, the Russell, all the indexes, have been putting in new highs, and that includes the NASDAQ Composite. It does not include the NASDAQ 100. I think the NASDAQ 100 is heavily tech-weighted, with some of the big tech names really strongly influencing it. And I think the NASDAQ 100 leaves out financial stocks, unless I'm mistaken.
No, I think you're right. Yeah.
And financial stocks have been a big driver of this rally the past 2 or 3 weeks, which would account for why the NASDAQ 100 and the NASDAQ Composite charts present themselves differently.
Yeah. And
yeah. So something to be to be aware of.
I think it's a good thing to utilize that at least on a person's weekly review, just to see the difference between the two, because you hit two crucially important issues, deals. Now, the reason I follow primarily the NASDAQ is because the Qs, the QQQ, is based off the NASDAQ 100, and so that. And that's basically the ETF and the leverage ETFs that we trade. But knowing this, so since this has, well, as we've seen, the financials have been doing really, really well lately, and so since this is busted, it has moved to a new high. That is very interesting. Now, when it hit these other past highs here, it was showing some negative divergence on the, it crossed here on a weekly basis when it hit that high.
And it did follow through to the downside for a period of 3 or 4 weeks.
Yeah, but now, let me go to one thing to take a look at is you can draw these trends. This is what I like about the TSI is it is actually, okay, if that was a resistance line from past, it is pushed up and actually broken through that a little bit now. And so so having that information, Mike, what's your takeaway from the differences between the two? I mean, you hit the financials, but just and I don't know if there's an ETF that trades the comp or not.
Yeah, I don't know, because I tend not to trade the NASDAQ. When I do trade, it's the Russell and the S&P, and I don't really have a takeaway.
Okay.
I just think it's important to know, the differences. It's easy to look at the NASDAQ 100 chart and say, well, all right, this thing doesn't look like the other ones, and it's lagging behind. But in reality, the NASDAQ Composite chart, which is a different entity,
right?
Those statements and conclusions don't apply, and and we've talked in the past about differences between the indexes, and even differences in the way the charts look among the indexes, and also the underlying ETFs that represent them.
Okay. I guess the one takeaway that as I'm thinking through this, the one takeaway that I will, just talk about is that the takeaway being that since the NASDAQ 100 is so tech heavy, for the tech stocks at least, there's the vigor that's come into the rally since the election has not been there. I don't know if it's an apprehension on the tech area, or if it's just that the power is going into these, these financials has been so great, just a total rotation that the techs have just been. That's not the That's not the place of interest for the people to invest in, for the big guys.
Well, it isn't right now, and again, you can get into the fundamentals of these things, but basically the dollar's been going higher, the interest rates have turned around, treasuries have gotten hit. These are all good things for financial stocks, and with the zero interest rate policies, financial stocks have been relatively not doing well.
Right.
Relative to some of these big name, big cap tech stocks, and the big cap tech stocks, who do a lot of their business overseas. What happens when the dollar, when the dollar gets stronger and the interest rates go up? Well, the profits are threatened. Because of the exchange rates and the currencies, and that's one thing, and then the other thing is some of these stocks, the Netflixes and Googles and Amazons had gotten so far ahead of themselves, and so incredibly overvalued that you add the valuation consideration to the implications of everything else the past 2 or 3 weeks, and so they're not participating in the rally to the same extent as some of the other ones that were relatively undervalued and potentially positively affected by these changes that we've seen since the election. And whether you agree with all that or not, I think that's been sort of the guiding force that's been driving this the past couple of weeks.
Yeah, Kieran has a good point here. He goes, he basically says that he thinks that part of the rotation is also out of the multinational techs and into the Russell with some of its more domestic, firms, U.S.-based firms and that kind of stuff, and so that may play a role in it also. But a lot of those, like if you take a look at Facebook, I'll come back here. Look at Facebook, okay? Facebook has fallen fairly nicely now. It looks like it may be getting ready for a bounce, but what about our buddy Netflix? Same. It's basically it had a huge run up after earnings, but now has given back all of that, not all, but a part of that big piece. What are the GOGL? Real nice, pull back into support, and then what am I forgetting?
Amazon.
There you go, Amazon.
Well, obviously these charts don't look the same as, like, for example, the Russell chart.
Exactly,
right?
Exactly.
And these aren't participating at all. And we can sit around and talk about why is that, and I've sort of expressed a couple of my opinions, but in the overall scheme of things, it doesn't matter why it's happening. What matters is that it is happening.
Exactly.
And there has a change in sentiment. There has been sort of a rotation out of some previously favored stocks and sectors into some new ones, and that's what the charts and the price action and the candlesticks are showing us. For whatever reason it's happening, that's what's happening. And I don't know that we really need to try to offer much more explanation or rationalization than that.
And so Dave says, David indicates international big tech companies after election are being asked to bring jobs back to the U.S., adds uncertainty to their future. So, okay, and here's where part of the rotation where it's going. Well, it's really interesting when things like Morgan Stanley start showing up on the IBD 50. that's a good indication that sector rotation is underway. Let's go back to the Russell real quick. The Russell, as you can see on a daily basis, the momentum has in fact turned over, but that doesn't mean it's going to, that doesn't mean it's going to fall out of the sky. And the momentum to the upside from the TSI has slowed down a little bit. We see that basically, I mean, this huge run here, big, huge, daily candlestick, and then it is basically just kind of, I won't say inch higher because it's moved up significantly, but it has on a lesser scale than it was under this move from here to here. It broke out to the new high, and now that is a new high, 1296 becomes now support, where it was resistance, and that now becomes a support area. And so where might, if it is approaching a high, and it's a good thing to throw your fibs on here, and we've gone from here up to here. And look at that, a 23.6 retracement would bring you right back down to that 1300 level. A drop below that on an overshoot. The magic fib box on a 1/3 to 2/3 retracement would bring it back into this level, which actually corresponds with the resistance, what would be a support zone that's made up of these candles here, just a little bit below that breakout level. So that's where it's not showing any indication that it is necessarily ready to turn around, but the upper momentum has slowed some. It is it definitely is very extended away from its moving averages, and at some point either it's going to stop, go sideways while the moving averages catch back up and then determine where it wants to go from there, or it's going to actually do a pullback into the moving averages, flatten out the trajectory of the moving averages, and then bounce from there. So anything just speaking to you here, Mike, on the Russell?
Oh, nothing that you haven't said, and nothing we didn't speak of, earlier in the session.
Okay. So great. Any questions on the indexes, guys and ladies? Okay, let's move on to, and we'll just finish up real quickly the rest of the story here. Okay. Well, Mike, the path of least resistance, at least right now, I mean, we are in clear sky on all the indexes. I mean, especially if you bring in the NASDAQ composite. They're in free space. And so at this point, given the candlesticks that are in place, we don't know where that upside resistance is.
Well, we don't unless you do Fibonacci extensions. Yeah. You don't have any upper resistance because, as you said, we're in uncharted territory here. But it does seem as if things have gotten a bit overdone.
Okay.
At least in the short to intermediate term, in my opinion, and certainly in the very long term they have. And I think we're due for a period of consolidation or, possibly retracement before, this move can continue further to the upside.
Yep. And so I'm just going to put up here, a pullback would be welcome.
I mean, we're due, and that doesn't mean it's going to happen. But
yeah.
Yeah, I mean, the more extreme this gets, the more violent or extreme the necessary pullback will have to be.
Yeah, and so, but keep an eye on the charts, both the weekly and the daily, and then throw in occasionally the hourly, because if we're not seeing any weaknesses on the daily or the weekly chart, oftentimes that weakness will start showing up a little. It'll show up earlier on an hourly chart, and you can check those not during the day necessarily, but just assess those during the after hours and say, okay, am I seeing anything, the initial signs of some weakness on an hourly chart or even a 2-hour chart, because that's where it will first show up. So we took a hit on our spider trade this week, and right now we've got a little bit of a drawdown this month of about 1.5% of our total investment. And but we will look at, we've got 5 weeks of trading left for the year, and we'll push from there. I get that question a lot. How much of a drawdown do you usually get on a week, during the year? And typically, our back testing, Mike, I think in all of the back testing that we've ever done, our max drawdown was what, 4 to 5%?
Yeah, something like that.
Okay. And so here's where we're sitting. As you can see, I post, our winners. I post, the ones we make a profit on, and right now our, equity curve has taken a little bit of a dip this month, but we'll see where we finish off the month of December as we start moving into December. Still, so let's see here. So we focus on 3 different strategies. Strategy 3 is some trades that we're doing where we have 3 long and short positions in both the spiders, the nugget, and Tesla. Tesla, we closed out 1 position that we had earlier in the year, and we had 100% gain on that. This Tesla trade, when we add in what's going on here, it's sitting at about 64 to 65% now. But anyway, it's a way that we, one, generate a little bit of both capital growth and also or income. And on average, we've hit 75%, win-loss ratio. Generate $273 per week on average, which approximates about $11.21 per month. Our objective with strategy 3 is to pay for the underlying position and put in a gain as the price action moves around. So future presentations. Let's see, monthly BAM meetings. This month, for the month of December, we're going to have 2 webinars to close out 2016 and to get ready for 2017. This Wednesday, training, don't buy the bottoms unless, and we're going to explain what the unless means. We put out some new videos. I'm going to be putting out some additional videos, a little short 5 to 10 minute videos. Mike and I are also working on one. We'll be working on one for the early warning alerts. Active trend trading enhancements, revised trader report. They're now coming out on Monday to better prep us for what's going on for the week. Night before pre-market alerts, final hour trade setups. That is what we'll be going to immediately after this, and then trading the leveraged ETFs. Active trend trading is based on 5 pillars of active trend trading: what to trade, when to enter, when to exit, what strategy we're going to use, and what our expectations are. And I always like to highlight this. A lot of times traders get lost in the strategies without having a sound system underneath the strategies. And I really appreciate getting emails. One young lady who trades with us, she has been applying and does a great job of following the rules with active trend trading system, and she's doing really quite well for this year. And she basically just says, hey, I'm just following the, and she's basically just taken and utilizing the 8-day moving average and the 20-day moving average and trading off of those, and has done really well. So, hey, see you guys next week. Have a great weekend. I know later today I'm going to be painting bedrooms again, but also watching Texas play. I think they're playing Texas Tech today, and I hope that you had a very, very good Thanksgiving with lots of naps and lots of pumpkin pie and that kind of stuff. So please trade wisely, trade profitably. Mike has already departed, so Mike, thanks for joining us today. And for premium members, we'll be doing the next final hour here in about 9 minutes. So, and also we've established a Twitter account. You can catch us at Active Trend Trading at trend_DWW. And moving into December, just to let everybody know that regardless if you are a what level of active trend trader you are, I'm going to be putting out at least one trade per month. That's going to be for everybody. So if you're not an active trend trader member now, I'm talking even the free newsletter member, please join, because I'm going to be tweeting out at least one trade, one trade per month when we get proper setups. So with that, folks, have a great weekend, and we'll see you next Friday. God bless everybody.